Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Back to the channel. Today, we'll be discussing the latest economic news, specifically the U.S. economy and the Federal Reserve's recent policy decisions. In summary, the U.S. economy is showing promising signs of recovery as more people get vaccinated and businesses reopen. However, inflation is on the rise, which has prompted the Federal Reserve to consider raising interest rates. Despite this, the central bank has signaled that it plans to take a measured approach to avoid derailing the recovery. The U.S. Federal Reserve has raised interest rates by 25 basis points last FOMC meeting. So, what does this mean for you and your investments? Stay tuned to find out. The U.S. Federal Reserve has been raising rates to prevent the economy from overheating. This move is expected to have significant implications for financial markets and consumers, as borrowing costs would likely increase. The Fed keeps raising rates to prevent recession. Recession is a word that strikes fear into the hearts of many, and with good reason. A recession can lead to job losses, a downturn in the stock market, and a general economic malaise that can affect millions of people. It's no wonder, then, that there are a lot of people who are expecting a recession in the near future, even if there's no certainty that one will occur. Survey after survey shows that fears of recession are high, and many people are wondering what kind of economic slowdown the United States could be facing. One thing to keep in mind is that no two recessions are alike. A recession could be a short, blip-ish event like the one caused by the pandemic in 2020, or it could be a more significant economic tsunami like the one that followed the housing meltdown in 2008. So, what kind of recession are we facing? There are several predictions currently circulating among economists and financial experts, ranging from a recession with a small r, to a slow cession, to a recession, to a potential soft landing. A recession with a small r is a relatively mild and short recession. In a recent poll of economists conducted by the World Economic Forum, nearly two-thirds of respondents believed there would be a recession in 2023, but many of those same analysts expect it to be relatively mild. Unlike the early 1980s, when the Federal Reserve's steep rate hikes sparked a brutal recession, this time around the economy appears to be reasonably resilient, despite grappling with the highest inflation rate in around 40 years. A big reason for this is the health of the labor market. Employers added 4.5 million jobs last year, marking a pretty spectacular comeback from the depths of the pandemic. A slow cession is a forecast that the economy will undergo a difficult period of almost no growth but will ultimately avoid an actual contraction. Moody's Analytics is one organization that believes in this scenario. In a report laying out its thesis, Moody's argues that the economy still has plenty of things going for it, including healthy household finances, as well as strong corporate balance sheets. Moody's believes those could help offset the economic consequences of raising interest rates, such as higher borrowing costs, lower economic growth, and more volatile financial markets. A recession is a recession or near recession that impacts the rich more than lower-income individuals. This would be unusual because recessions typically hurt the relatively less well-off the most. However, in this case, lower-income workers may find themselves more insulated than in previous recessions. The labor shortages during the pandemic forced many businesses to boost wages to recruit staff. Wage gains at the bottom of the income scale were proportionately larger than those at the top, although many workers' wage gains were partially eroded by inflation. Inflation is now easing, but the wage gains remain. That factor should help lift the overall net worth of lower-income workers as they face a potential recession. A soft landing is a scenario in which the economy slows but doesn't contract, and unemployment doesn't spike significantly. The Federal Reserve has continued to argue it has a path to raise rates without sparking a recession. Some recent indicators point toward that more optimistic scenario. Inflation continues to moderate, with the annual rate falling to 6.5% in December from a peak of 9.1% in June. Some of the factors that especially worried the Fed are also trending in the right direction, including cooling wage and price increases. That has allowed the Fed to moderate the size of its rate hikes, and analysts now expect the central bank will raise rates by only a quarter percentage point at its meeting next week. Despite the market turbulence, most analysts believe the economy remains on solid footing, with unemployment low, inflation tame, and consumer and business confidence strong. And while trade tensions with China and other countries have raised concerns about the outlook for growth, most economists say the impact so far has been modest. In conclusion, the Federal Reserve's decision to raise interest rates reflects the strength of the U.S. economy and its continued growth. The Fed's gradual approach to rate hikes is a deliberate move to avoid disrupting the current economic expansion, while also ensuring that inflation remains in check. As the Fed continues to monitor the economic landscape, investors will be paying close attention to any signs of future rate increases and their potential impact on financial markets. However, for now, the Fed's latest move appears to have been well received by investors, as stocks have rallied in the wake of the announcement, but as the news digested, the financial market quickly pulled back due to fears of banks and financial system collapse. Thanks for watching the latest news and analysis of the Fed's decision to maintain interest rates. If you found this content helpful, please consider liking and commenting below. Don't forget to subscribe to our channel for more informative videos like this one. As a reminder, this video is for informational purposes only and should not be considered financial advice.